Hello students, welcome to all of you Shiksha 360, and today we will cover the basically chapter number 22, that is components of ALM part 2. Clear? Basically this is BFM, basically chapter number 22, components of ALM, basically part 2. Clear? This chapter is important because this is basically theoretical chapter and only one or two formulas which we have already discussed that we will cover in this session. Clear? So basically you have to go through the slides also. Clear? So let's start basically in this session. First of all, we will discuss what is asset liability management. Clear? So what is asset liability management? Clear? Because the business of banking, clear, because the business of banking basically involves the identifying, clear, because the business of banking basically involves the identifying, measuring, accepting and managing the risk. Clear? Because the business of banking basically involves the what it involves basically identifying, measuring, accepting and managing the risk. Clear? So the heart of bank financial management is the risk management. Clear? So which of the following is the heart of bank financial management? The heart of bank financial management is a risk management. Clear? Basically they have already asked this question, basically which of the following is the heart of the bank financial management. Clear? Which of the following is basically the heart of the bank financial management? So that is basically the risk management. Clear? Risk management, it is basically the heart of the bank financial management. Clear? So one of the most important risk management function in banking is asset liability management. Clear? One of the most important function in the banking, it is to be basically asset liability management. So let's discuss in detail. Traditionally administrated interest rates. Clear? Basically traditionally administrated interest rates were used to price the assets. Clear? Traditionally basically administrated interest rates were used to basically to price the assets and liabilities of the bank. Clear? Earlier. Now basically what will happen in the deregulated environment? Clear? Interest rate basically as per the RBI guidelines. Clear? Presently we have banks own guidelines to change the interest rate, and after that basically new concept is introduced of the MCLR, and presently basically which is going to be RLLR. Clear? Presently the concept of RLLR is going to be done. Clear? So traditionally administrated interest rates were used to price the assets and liabilities of the banks. Clear? However, in the deregulated environment, clear? However, in the deregulated environment, basically competition has narrowed the spread of banks. Clear? Basically, what is the basically meaning of spread of banks? Basically the margin. Clear? Basically the margin of the banks. Clear? Clear? However, in the deregulated environment, clear? Basically, however, in the deregulated environment, competition. Clear? Basically, however, in the deregulated environment, basically competition has narrowed the spread of banks. Clear? Basically, this not only has led to the introduction of discriminate pricing policies, but also highlighted the need to match the maturity of the assets and liabilities. Clear? What is the meaning of that? Clear? But has also highlighted the need to match the maturities of the assets and liabilities. Clear? So what is the meaning of that? Clear? But has also highlighted the need to match the maturities of the asset and liabilities. Basically, we can say that, like, if you having FD, fixed deposit of maturity, clear? Basically having 10 lakh amount and maturity is 3 years. Clear? And basically you are giving the loan also. Clear? Of 10 lakh having basically, and that amount basically come in 7 years or 5 years. Clear? So basically here 2 years gap. So that is basically they are saying that basically we have to need to manage. Clear? Basically we have to need to manage the also the basically what basically we have to do the assets and liabilities. Clear? Basically we have to do also the manage the assets and liabilities. Clear? Maturities of the assets and liabilities. So the borrower, the changes in the profits. Clear? Basically the changes in the profile of the source and the use of funds. Clear? The changes in the profile of the sources and the uses of funds are reflected. Clear? And the uses of funds basically are reflected in the borrower's profile, the industrial profile, and the exposure limit for the same. Clear? The changes in the profile of the sources and uses of funds are basically reflected in the borrower's profile, the industry profile, and the exposure limits for the same. Interest rate structure for the deposits and advances, etc. Clear? Basically we have to manage all these things. Clear? Basically we have to manage all these things. So the developments that have taken place since liberalization, basically we can say that after 1991, clear? Basically this question we have already covered in the ABM today. Clear? Basically they have asked the question basically when the economic reforms takes place. Basically the answer is 1991. Clear? So the development that have taken place, clear? The development basically that have taken place since liberalization basically have led to a remarkable transition. Clear? Basically have led to a remarkable transition in the risk profile of the bank. Clear? Basically have led to a remarkable transition. Clear? Basically have led to a remarkable transition in the risk profile of the bank. So now next is basically asset liability management. Clear? Asset liability management basically it is concerned. Clear? Asset liability management is concerned with the strategic balance sheet. Clear? Asset liability management it is basically concerned with the strategic balance sheet management involving risks caused by banks in interest rates, exchange rate, credit risk, and the liquidity position of the bank. Clear? So basically asset liability management is concerned with the strategic balance sheet management. Clear? With the strategic balance sheet management basically involving what risk basically involving risk basically caused by changing in the interest rate. Clear? Like we can say that basically we have created a FD fixed deposit having 7% interest rate. Clear? At that time basically interest rate on the loan is to be 10%. Clear? Basically what will happen? This FD is of 5 years. Clear? Basically and FD is created in the year 28. Clear? But in the year 2020 the interest rate on loan is to be reduced and it is linked to the RLR. Clear? So basically interest rate is now reducing to the 7.5%. Clear? So basically earlier the gap is to be 3%. Now gap is only 0.5%. Clear? So basically this is the main risk, basically changes in the interest rate. Or second one, basically we have to say that basically credit risk and the liquidity position of the bank also. Clear? Basically and the liquidity position of the bank also. Clear? Basically we have to face all these risks here. Clear? So basically with the profit, clear? Basically now with the profit basically becoming a key factor, it has now become imperative. Clear? Basically with the profit becoming a key factor, it has now become imperative. Clear? It has now become imperative basically for a bank. Clear? Basically for a bank to move from partial asset management. Clear? Basically for a bank to move from, clear? Basically for a bank to move from partial asset management, that is credit and non-performing, and partial liability management. Clear? Towards an integrated balance sheet management. Clear? So basically now it has become imperative basically for a bank to move away, clear? Basically to move away from a partial asset management and a partial liability management. Basically now basically they will move towards an integrated balance sheet management. Clear? Basically where all the components of balance sheet and it's a different maturity mix will be looked at a profit angle of the bank. Clear? Basically they have to work towards the integrated balance sheet management. Clear? Basically they have to work towards the integrated balance sheet management, basically where all the components, clear? Basically where all the components of the balance sheet and it's a different maturity basically mix will be looked at profit angle of the bank. Clear? At profit angle of the bank. Clear? So basically here what we'll discuss, basically here we will take only one fixed deposit and one loan. Clear? But this does not happen actually in the present. Clear? Basically there are fixed deposit are done on the daily basis, cash deposit in the accounts are done on the daily basis, and loans are also going on. Clear? So basically it is a continuous process. Clear? It is a continuous process. So they have to manage according to that. Clear? So basically they have to manage according to that. So basically asset liability management. Clear? Next one, basically asset liability management is the act of planning, acquiring, and directing the flow of funds. Clear? So what is asset liability management? It is the act of planning, acquiring, and directing the flow of funds basically through an organization. Clear? So in the basically nutshell, basically we can say that asset liability management, it is the act of planning, acquiring, and directing the flow of funds basically through an organization. Clear? So the ultimate objective, clear? The ultimate objective of this process is to generate adequate and stable earnings. Clear? The ultimate objective of this process is to generate adequate and stable earnings and to steadily, clear? And to steadily basically build an organization equity over time. Clear? And to steadily basically build an organization equity over time while taking reasonable and measured business risk. Clear? And to steadily basically build an organization's equity over time while taking reasonable and measured business risk. Clear? Basically while taking reasonable and measured business risks. So that is basically asset liability management. Clear? So now next, this is basically now ALM. Clear? Asset liability management is therefore basically the management of the net interest margin. Clear? Basically what we have discussed, basically it is the management of the net interest margin. Clear? And basically net interest management, basically we can say that in the end basically the bank has to get some profit. Clear? Basically in the end basically bank has to earn some profit. Clear? So asset liability management is therefore the management of the net interest margin, basically to ensure that its level and riskiness. Clear? Basically to ensure that its level and riskiness are compatible. Clear? Its level and riskiness basically are compatible with the risk or return objectives of the bank. Clear? Basically its level and riskiness are compatible basically with the risk or return objectives of the bank. Clear? So ALM is basically more than just managing the individual assets and liabilities categories well. Clear? So it is an integrated approach. Clear? Overall we can say that it is basically an integrated approach to bank financial management, requiring simultaneously decision about the types and amount of financial assets. Clear? Basically regarding decisions regarding what? Basically about the types and amount of financial assets and liabilities it holds, or it mix and volume. Clear? So in addition, basically we can say that asset liability management requires a basically understanding of the market area basically in which the bank operates. Clear? In general, we can say that basically asset liability management basically requires an understanding of the market area. Clear? Asset liability management basically requires an understanding of the market area basically in which the bank operates. Clear? Basically in which the bank operates. Clear? So the strategy of actively managing the composition and mix of assets and liabilities portfolios, it is basically called as balance sheet restructuring. Clear? Balance sheet restructuring. Clear? I think all of you are aware that basically in the chapter number 27 of ABM, clear, you have learned regarding the balance sheet. Clear? You have learned regarding the balance sheet. Clear? Basically what are the components of the balance sheet? Clear? Basically what are the components of the balance sheet? So now basically we will move towards the next point. Significance of the asset liability management. Clear? What is the significance? Clear? Like basically here we have discussed one example regarding that we have given a fixed deposit at fixed interest rate, that is basically 7% basically for 10 years. Clear? Or 5 years. Clear? Similarly we have loan. Clear? Same thing basically they have able to understand here, basically telling here basically significance of asset liability management. Clear? Basically why do we need the asset liability management? Clear? First thing basically we have to understand here, basically why do we need the asset liability management? Clear? So in simple terms we can say that, in simple terms basically a financial institution, clear, in simple terms we can say that a financial institution may have enough assets to pay off its liabilities. Basically a financial institution, we can say that basically a financial institution, always basically a financial institution basically may have enough assets basically to pay off its liabilities. Clear? But what if 50% of the liabilities are maturing within 1 year? Clear? Basically what will happen if the 50% of the liabilities, clear, basically if the 50% of the liabilities are basically maturing within 1 year, but only 10% of the assets are maturing within the same period? Clear? We are saying that basically, but if 50% of the liabilities are maturing within 1 year and only 10% of the assets are maturing within the same period, like we can say that basically 50% liabilities, clear, basically bank will have to pay 500 crore. Clear? Basically bank will have to 500 crore and only bank will get basically 10, basically 100 crore. Clear? From the maturity of the assets. Clear? So basically here there is a gap of 400 crore. Clear? Basically here there is a gap going to be, that is 400 crore. Clear? So basically bank has ability to pay that much amount. Clear? Basically here bank has the power to pay that much amount. Clear? Basically, but only 10% of the assets are maturing within the same period. Clear? Basically they have to pay that amount to their customers. Clear? So the financial institution has enough assets. Clear? Has enough assets. Basically it may become temporarily insolvent basically due to the sure liquidity crisis. Clear? Basically, but temporarily. Clear? It may become insolvent basically due to the sure liquidity crisis. Clear? Because they have earning only 100 crore and they have to pay the 500 crore. Clear? So basically these types of things basically lets problem. Clear? So basically we only due to these types of things basically we need asset liability management. Clear? So thus we can say that ALM is required to match the assets and liabilities and minimize liquidity as well as market risk. Clear? So basically in general we can say that basically ALM is required basically to match the assets and liabilities and minimize liquidity as well as market risk. Clear? And minimize liquidity as well as market risk. Clear? So asset liability management basically can be performed on a per liability basis. Clear? So we can say that basically asset liability management basically can be performed on a per liability basis by matching the specific asset to support each liability. Clear? Basically, we have to create, clear? Basically, we have to manage in that way. Basically, if our one liability is maturing, so basically here one asset is also continues to be maturing here. Clear? So basically, you ensure that for every liability, clear? Basically, for every liability, there is an equivalent tenure and amount matching asset. Clear? Basically, for every liability, basically, there is an equivalent tenure and amount matching assets. Clear? Basically, there are an equivalent tenure and amount matching asset. Clear? Basically, which is to be required here. Clear? So that is the significance of the asset liability management. Clear? And I think many of you have already attended the question or go through the slides. So I request to all of you basically who are not going through the slides, please go through the slides also and try to practice all the questions basically which are provided in your Telegram group. Clear? So now basically we will move toward the next thing. Again, even if the assets and liabilities maturity is mismatched. Clear? Again, even if the assets and liabilities maturity is mismatched to a large extent. Clear? The interest rate. Clear? So here the interest rate can change during the period, thereby affecting the interest income from assets and interest expenses on the liabilities. Clear? Basically, we can say that again, even if the assets and liabilities maturity is matched to a large extent. Clear? Basically, even if the assets and liabilities maturity is matched to a large extent, clear? The interest rate can change during the period, thereby affecting the interest income from assets and the interest expenses on the liabilities. Clear? Basically, that is basically we can say that FD is basically having fixed interest rate 7%, and the interest rate on loan basically earlier it is to become 12, then 10, then it becomes 7.5 or 7.7. Clear? So that is basically this affects overall affects the interest income. Clear? Overall affects the interest income. Like we can say that presently on the car loan. Clear? Basically, some banks are offering 7.7%, 7.8%. Even some banks are offering, like we can say that presently, I have read somewhere, basically presently PNB is offering 6.9% or 6.8% on the car loan. Clear? So basically there is a gap clear between different banks only on the car loan. Like here we can say that basically 1% gap. Clear? Basically this is a large gap. Clear? So that is basically this at on the fixed deposit. Basically on the fixed deposit we are paying that 5.7 or 5.8%, and basically on the car loan basically how much we will get, basically like 6.9 or 7%. Clear? So this is the gap. Clear? So basically this is the gap which we are facing, and this basically also shows that. Clear? Basically this also shows that basically in the upcoming time this gap is going to reduce. Clear? Basically this gap is going to reduce. So basically how or where the bank will earn profit now. Clear? So basically depending upon the movement of interest rate, the net interest margin. Clear? Basically depending upon the movement of interest rates, the net interest margin basically may increase or decrease, resulting in corresponding increase or decrease in profit during a certain period. Clear? So depending upon the movement of interest rate, basically the net interest margin. Clear? Basically the net interest margin basically may increase or decrease, resulting in a corresponding increase or decrease in profit during a certain period. Clear? So now basically what are the reasons for growing significance of asset liability management? Clear? Now basically what are the reasons basically for the growing significance of the asset liability management? Basically first one is the volatility. Clear? Basically volatility. Clear? Basically system is continuously volatility. We can say that basically the interest rate changes very fast. Clear? Interest rate changes very fast. Clear? Basically for, or we can say that like, let's discuss basically deregulation of financial system. Clear? Basically change the dynamics of the financial markets. Clear? The vagaries basically of such free economic environment are reflected in the interest rate structures, money supply, and overall credit position of the market, the exchange rates and the price levels. Clear? Basically exchange rates also fluctuate very fast. Exchange rate. Clear? So basically that also leads to the volatility. Clear? Basically that also comes under the volatility. Clear? Basically for a business which involves trading in money rate fluctuations, clear, invariably affect the market value, yield, cost of assets and liabilities, which further affect the market value of the bank and its net interest income. Clear? And its net interest income basically NII. Clear? Like we can say that basically how trading in money or currency exchange fluctuations. Clear? Basically like earlier basically there is not that much fluctuation in the currency rate. Clear. Presently there are lot of fluctuations. Clear. Basically within seconds. Clear. Basically price change. Clear. Basically that also comes under the volatility. So basically we have to maintain the asset liability management. Clear. Basically how? In the exchange, like we are purchasing, basically bank has $10,000 at 64 rupees. Clear. Now basically the rate of the dollar is now going to increase. Clear. 64.50. Clear. So here basically bank will face the loss. Clear. Here bank will face the loss. Clear. Because they have already purchased at less price. Clear. Basically they have already purchased at the less price, or basically loss. Basically we can say that basically when the price $1 is goes to 63.50. Clear. So in that case basically bank will face the loss. Clear. That is basically known as the volatility. Clear. Basically now basically with the enhancement of the technology. Clear. Basically with the enhancement of the technology, these things are easily checked. Clear. So basically these in the net, basically it affects the net interest income of the bank. Clear. Next one is product innovation. Clear. Basically product innovation. Clear. Like we can say the product innovation basically like flexi deposit facility. Clear. Basically flexi deposit facility. Basically what is the meaning of that? Basically on the saving account, banks are giving 3%. Clear. Basically, but they have mentioned one thing. Basically if the amount in the account is above 50,000. Clear. But there is a facility from the bank that you can create a flexi deposit. Clear. Basically flexi deposit, what is the meaning of that? Basically that above amount. Clear. Basically like we can say that in the account we have 90,000 rupees. Clear. So basically 40,000 rupees that directly basically converts into a fixed deposit, and you are earning the interest rate of fixed deposit on that amount. Clear. And you are earning the basically interest rate of fixed deposit on that much amount. Clear. So that is basically known as the flexi deposit facilities. Clear. So product innovation. Clear. Basically also lets the significance of asset liability management. Clear. Management. Clear. So basically what is the meaning of that? Basically where in one case basically we are providing only the saving interest, and here basically we are providing the fixed deposit and interest. Clear. Basically fixed deposit interest, basically more interest to the customer. Clear. Basically more interest to the customer. Clear. So that is basically known as product innovation. Clear. Next one basically we have to regulatory environment. Clear. Basically regulatory environment. Clear. So at the international level. Clear. Basically at the international level, basically bank for international settlement, BIS. Clear. At the international level, basically BIS, bank for international settlement, provides a framework. Clear. Basically they will provide a framework for banks to tackle the market risk that may arise basically due to the freight fluctuation and excessive credit risk. Here. So basically time to time. Clear. Basically time to time, BIS basically provides a framework for banks to tackle the market risk basically that may arise due to rate fluctuation and excessive credit risk. Basically what are the guidelines we have already discussed? Like we have already discussed in the module B. Clear. Basically module B are all are related to the risk. Clear. Basically in that basically we have discussed individual what is market risk, what is credit risk, what is operational risk. Clear. We have discussed all these points. Clear. Basically all these points one by one. Clear. So next one is the management recognition. Clear. Basically how they have managed. Clear. So above the all mentioned aspects. Clear. Basically above the all mentioned aspects, forced bank managements to give a serious thought to effective management of assets and liabilities. Clear. Basically if the assets and liabilities are not effectively managed. Clear. If the assets and liabilities are not effectively managed, this leads to the risk to the bank. Clear. So the management have realized that it is not just sufficient to have a very good franchisee basically for credit disbursement, nor it is enough to have a just good retail deposit base. Clear. So basically it means that basically management have already understood that it is not like that getting credit or disbursing the loans. Clear. So basically in addition to this, clear, where bank should be in a position to relate and link the asset side basically with the liability side. Clear. And this calls for efficient asset liability management. Clear. Basically in addition to this, or we can say that basically in the nutshell, basically the bank has to be in a position to relate. Clear. Basically to relate and link the asset side basically with the liability side. Clear. And basically they have to relate. Clear. And basically in a position to relate and link the asset side basically with the liability side. Clear. And link the asset side basically with the liability side. And this calls for the efficient asset liability management. Clear. and basically this calls for the asset liability management. Clear? There is increasing awareness in the top management that the bank is now a different game altogether, since all the risk of the game since have been changed. Clear? Basically with the passage of time. Clear? Basically with the passage of time, all risks are going to be changed from time to time. Clear? Basically with the passage of time, all risks are going to be changed. Basically they are saying the same thing here. Clear? So management recognition, and the management has to recognize all these things here. Clear? Properly. That is basically management recognition, regulatory environment, volatility, and product innovation. Clear? Basically these are the main reasons for the increasing significance of the asset liability management. First one is the volatility, second one is the product innovation, third one is the regulatory environment, fourth one is the management recognition. Clear? So next one basically which we have to discuss. Clear? The parameters. Clear? Basically what are the parameters that are selected for the purpose of stabilizing asset liability management? So what are the parameters? First one is the net interest income, second one is the net interest margin, third one is the economic equity ratio. Clear? Basically these are the three parameters basically that are selected basically for the purpose of stabilizing of the asset liability management. First one is the net interest income, second one is the net interest margin, third one is the economic equity ratio. Clear? Third one is the economic equity ratio. Clear? So let's discuss first one, net interest income. Clear? So what is net interest income? Basically the impact of volatility. Clear? Basically on the short term profit. Clear? So basically the impact of volatility basically on the short term profit is measured by the net interest income. Clear? The impact of volatility basically on the short term profit, it is to be measured by the net interest income, and net interest income here is to be basically interest income minus interest expenses. Clear? So basically how much we will earn as interest and how much basically we have to pay as a interest, that is basically the difference of both basically comes out to be net interest income. Clear? The difference of both basically comes out to be the net interest income. So net interest income basically here comes out to be interest income minus interest expenses. Clear? So in order to stabilize short-term profits, clear, in order to stabilize basically short-term profits, bank have to minimize fluctuation in the net interest income. Clear? So in order to stabilize, clear, basically in order to stabilize short-term profits, clear, in order to stabilize short-term profits, the banks have to minimize fluctuation in the net interest income. Clear? Basically banks have to minimize fluctuation in the net interest income. So next one is net interest margin. Clear? Basically net interest margin. So net interest margin is defined basically as the net interest income, that is basically interest earned minus interest paid divided by the average total assets. Clear? Basically divided by the average total assets. Clear? Basically net interest income, clear, is basically equal to the net interest income by divided by the average total assets. Clear? Basically you have to remember these formulas also. Clear? We will discuss numericals on that also. Clear? Net interest income is basically equal to net interest margin is equal to basically net interest income upon the average total assets. Clear? So net interest margin basically can be viewed as a spread of on earning assets. Clear? This can be also viewed as a spread. Clear? So the net interest income of banks basically comes mostly from the spread basically maintained with the total interest income and total interest exposure. Clear? Basically the higher the spread, the more will be the net interest margin. Clear? The higher the spread basically, the more will be the net interest margin. Clear? That is the basically the total interest income and the total interest exposure. So next one basically which we have to discuss, one, this is also important. Basically there exists a direct correlation between the risk and the return. Clear? As the risk is more, the return is more. Clear? As a result, greater spread basically only imply enhanced risk exposure. Clear? Basically that we have enhanced our risk exposure. Clear? So but since any business is conducted, clear, but since any business is conducted with the objective of making profits and achieving higher profitability is the target, so it is the management of this risk that holds key to success and not elimination and not risk elimination. Clear? Basically what the meaning of that is. Clear? Basically they are saying that basically any business is conducted, clear, basically, and basically any person is doing the business basically for what? Basically for earning the profits. Clear? And basically that is high profitability. Clear? And we can say that basically high profitability basically also have the high risk. Clear? But we have to manage that risk. Clear? Basically what we have to manage that risk and earn the profit. Clear? Basically but we have to manage that risk and earn the profits and not risk elimination, clear, and not risk elimination, clear. Basically we can say that if we are not taking the risk, clear, basically if we are not taking the risk, then we are not able to earn that much profit, clear, basically then we are not able to earn that much profit, clear. So that is basically net interest margin, clear. So last one, basically economic equity ratio, clear. Economic equity ratio, what is the meaning of that? Basically the ratio of the shareholders funds to the total assets measures the shifts in the ratio of owned funds to the total funds, clear. Basically the risk, basically the shifts in the ratio of owned funds to the total funds, clear. So this fact assesses the sustenance capacity of the bank, clear. Basically this fact assesses the sustenance capacity of the bank, clear. So basically if anyone asks basically what is the economic equity ratio, economic equity ratio, so basically what is the economic equity ratio? Basically shareholders funds upon total assets, clear, upon total assets. That is basically economic equity ratio, clear. The ratio of the shareholder funds to the total assets, clear. Basically measure the shift in the ratio of owned funds to the total funds, clear. Basically measure the shift in the ratio of owned funds to the total fund, that is economic equity ratio, clear. That is economic equity ratio, clear. Basically these are the three important funds which we have to discuss: net interest income, net interest margin, and the economic equity ratio, clear. So basically this leads to the completion of our topic, and I request to all of you, clear. Basically I request to all of you, please read the topic through the slides also, clear. Basically please go through the slides once again and try to watch the video, clear. And after that basically you have to practice the question, clear. We'll provide you more questions tomorrow on this chapter, clear. Some numericals also and some theoretical questions more, clear. So, and I request all of you, please go through the topic, because you will get at least 3 to 4 questions directly from this topic, and very rare chances of case studies, clear, basically from this topic also. So basically theoretical question or 1 or 2 marks numerical question they will ask basically from this chapter, clear. So thanks to all of you for watching this session.